A lot of the well-funded AI startups are struggling to get customers. Having a better solution doesn't mean you get the customer. People would build a better solution and they knock on a lot of doors and they wouldn't get the customers. And so then they would have to go buy someone who had the customers. And so it's easy to think about AI as creating a lot of valuable companies that get bought for a lot of money. What we're seeing is almost the opposite. Valuable AI companies that realize they can't scale unless they go acquire the customer. So they go acquire the customer.
So welcome to yet another edition of my podcast. So today we are joined by Mr. Nat Burgess. He's the founder and managing partner at TechStrat. With decades of experience in technology M&A, startup mentoring, and venture investing, Nat has advised on more than 100 transactions involving the big names like Microsoft, Google, Intel, etc. So today we will explore trends shaping tech deals, entrepreneurship, and the future of innovation along with Mr. Nat. So thanks a lot, Nat, for joining this session with us.
Thank you for having me on.
So to start with, I would like to understand, could you walk us through your career, your background, and some key milestones in your professional journey so far?
Yeah, happy to do that. So I'm old. I started.
You doesn't look like that.
I went to Wall Street in 1989. So I worked for Morgan Stanley in the M&A group, first in New York and then in Tokyo. So I got involved in cross-border deals, but I had attended the same high school as Bill Gates, and we had early access to computers. So I learned programming as a high school student. And when I came back to the US in the early 90s, I went back to banking, but focused on technology. So technology was not a segment for investment banking when I started. But by the time I came back to the US and finished my law degree and got going again in the mid 90s, it was. So internet was coming on. And I helped build another boutique investment bank. I worked for Activision doing online gaming, so multiplayer gaming over the internet when that first became possible. Did an internet startup early days. And then since then, as you mentioned, I've advised on about 120 transactions. I've invested in about 30 different companies. We've sold one to Google, one to Yahoo. We've had a number of exits. We've had a number that didn't work out, but we don't need to talk about those. And over the years, obviously, I've used different tools to support my investing and M&A practice. When I started at Morgan Stanley, we would have to go take a taxi to the publisher and get documents out of file cabinets and bring them back to the office. There was no internet yet. Financial publishing was a big business. Thomson Reuters, Wolters Kluwer. We did have Quotrons at our desks, but computers were very limited. And gradually we evolved into the world we're in now, where a lot more data is available from subscription services and available to support our practices. And then similarly, the technology environment has gone through multiple major evolutions. So we started out as discrete computers in offices, and we went to client server, and then we went to internet, and then we went to ASP, or application service provider, and then we went to SaaS, and then we went to data cleanup so people could do AI, and then we went to AI, and it changed everything, and it's quite different. So I think I have a historical perspective, having worked for the last 37 years on in this rapidly changing environment. So very intrigued to sort of think about what the current trends look like in the context of the trends that came before, and also what the tools of the future will be to support practices like ours and like Tracxn provides.
Great. So as you mentioned, you started with maybe a diary for noting down who can be a buyer, who can be what transactions, from paper and pen, maybe then to a floppy disk, then to a CD, then to a DVD, then maybe a pen drive. So that's a long journey.
And I had the rare privilege of introducing the monkey virus into my office on a floppy. I literally brought a floppy into the office and I put it in an IBM AT computer and it infected the entire office because we didn't have internet yet, but that was the vector. But yeah, when we used to do peer groups back in those days, we would literally go and get all the 10Qs and 10Ks from the publisher, and we would manually input numbers into Lotus 1, 2, 3, and then we would generate our result. And the private transaction data, we would call people. We would literally call, and sometimes it was as simple as like make a guess and ask them to deny it, kind of thing. Very, similar problem with the confidential data, like getting to stuff that you could trust and that two parties could rely on was a challenge. When the NASDAQ was more populated with small companies, a lot of the transactions were material, and so details had to be disclosed and we could find them in the quarterly filings. But not so much anymore. Most of the activity is private, as you said, secondary, it's private equity. So that data is just not widely available.
So I'm sure that in all these transactions you have worked on, is there any interesting story which you can share with our viewers? Something which is interesting?
Well, I mean, it's been a long road. I could tell you, and I'm trying to think of stuff that's directly relevant, but we did have one transaction where we had negotiated it over months. We were Friday, it was supposed to close Monday morning. It was about a $35 million transaction. This would have been 15 years ago. And on Friday, the CEO of the acquiring company changed his mind. It's like, we're not going to do this. We're not going to do this. And I don't know exactly what his reasoning was, but he called me on Friday and said, the deal's off. And I said, okay. We had backup offers. So we were like, okay, we'll just go sell to someone else. And then Monday morning, I got a call from my client saying, we just got a wire transfer for $35 million because they canceled the deal, but they forgot to tell the bank. So, I mean, we sent the money back, but yeah.
That's interesting.
Yeah.
But did somebody else buy the company?
No, actually. So we sent the money back, and then a week later, I guess cooler heads prevailed because they came back and said, you know what? We want to do the deal after all. The good news is the wire transfer fee was $25. And so moving all that money back and forth a few times didn't really have a cost. So.
Oh, that's interesting. Very interesting.
And I have other deals. Technology changes so fast that sometimes your assumption is false the next day. So I can think of deals we did 2 or 3 years ago that provided services that are now replicated very easily with AI. So $50 million transaction for a solution that I could spend a weekend creating in Claude Code. Now, I wouldn't have the customers, but still, it's very different. So, and I remember one deal I worked on that was a memory manager for Windows before Windows could do memory management. And, literally weeks after that deal closed, Microsoft announced that they were going to implement that. And so the value of the deal effectively went to zero. That happens. But it goes the other way sometimes too, where someone makes a smart buy and the market improves and they're off to the races.
That's good. So what would be a top focus for 2026 and the coming years? Because you have seen an evolution of how these tech startups are coming up, how the M&A happening in that ecosystem. So what's your prediction for 2026 and the upcoming years?
Yeah, that's a fun question. I actually used to go on CNBC every January and predict the big tech M&A deals of the year. Wow. And when you do that, people generally don't call you out if you're wrong, and they celebrate you if you're right. That's, when you're in media, you're not really responsible for anything. You just try to sound smart in the moment. But anyway, a couple thoughts. So first of all, we used to use tech employment as a barometer of upcoming activity. Actually, back in the day, M&A used to move in lockstep with the public market. So when NASDAQ was up, tech companies would buy, the opportunities would be there, we'd see deal volume go up. That connection gradually broke, and then we started tracking a connection between tech sector employment and M&A volume. So the more aggressively the tech companies were hiring and the more scarce the talent was, the more deals would be happening. And we could pretty reliably use that. That connection started to break in 2022 when we saw the layoffs and the first inkling of the potential of AI. And what we're seeing now is the tech employment dropping pretty dramatically. Most of our clients are seeing roughly half of their tech workforce fall away at this point. And it's always the half that doesn't embrace the AI tools. So you might have 20 people in R&D, you might have 10 that amplify their own contributions by adopting and using the AI tools. You might have another 10 that are like, I'm not going to do that. AI is my enemy. I'm not going to touch it. Well, they're going to be unemployed very quickly. So the whole tech sector employment is dropping, and a lot of the well-funded AI startups are struggling to get customers. Having a better solution doesn't mean you get the customer. And we saw that with the transition from on-prem to ASP or SaaS. People would build a better solution and they'd knock on a lot of doors and they wouldn't get the customers. And so then they would have to go buy someone who had the customers. We're seeing that happen a lot right now. So most of our deal flow last year was companies with a good customer base and a good, loyal relationship with their customers being acquired by AI companies that could then do more for those customers. And I'm thinking of the sale of Insight Engine to HData, WorkOtter and PPM, Alltech being acquired by Beyond AI. These are all companies that have customers and are providing a real service, and then they don't have the capital base to really build out robust AI solutions, so they get bought. Newsletter acquired by SimilarWeb. I mean, we have dozens of these examples, and that slowed down a little bit, but we think that's going to pick up again. We think that there are better ways to service these customers. And so it's easy to think about AI as creating a lot of valuable companies that get bought for a lot of money. What we're seeing is almost the opposite. Valuable AI companies that realize they can't scale unless they go acquire the customer. So they go acquire the customer. And that's a lot of our deal flow right now.
Yeah, that's a great insight. I never thought in that direction. So that's something, a food for thought for all our viewers also.
Yeah, I mean, what that means from a data standpoint is if I'm only following investment rounds in the new generation of AI company, I'm not necessarily gathering data on the sellers, who's going to be acquired. And those are often more legacy, call them legacy companies, existing companies that have built up over time. And maybe they don't have the shiny new tech yet, but they've got the customers.
So how are you incorporating AI in your current workflow? Like how you mentioned, you started with paper, pen, then floppy. Like how do you incorporate AI in your daily workflow right now? And how is it positively affecting your entire work system?
So when I started TechStrat in 2015, I basically broke down the investment banking practice into a set of processes and outcomes and templates with the goal of being able to train people on discrete aspects of the process. And it's the familiar, same thing I was doing in 1990. It's peer groups, it's precedent transactions, it's partner candidate lists, it's synergy analysis, it's monitoring buyers to see what products they're announcing, it's monitoring buyers to see if they've raised capital, it's following key people who tend to make acquisitions and seeing where they land. So we literally cataloged about 25 of those processes, and then we trained up our analyst teams on how to do that work, and they're really good at it. And the good news is we didn't expand our back office a lot. We basically stayed small, but we stayed very effective in those processes. And now, 11 years later, every one of those can be anywhere from 20 to 80% automated with AI. And not only that, but the outcomes can be integrated into cohesive presentations. And a lot of the analysis, it used to be that the LLMs were 6 or 12 months behind, so the data was useless, but now they're pretty caught up and it's much more current. And so at the end of the day, we can take those 25 processes and we can largely automate them with AI. with the same knowledgeable analyst team creating prompts where we need to, or orchestrating these AI agents, and then reviewing and improving or fixing the outcomes. So I think our practice was maybe more process oriented than most and less people oriented. We love our people and they're really good, but we try to take the people out of the process and focus on process. And that's a very rational place for AI. So the other really good news about AI is that it allows us to integrate external data more immediately and readily into our documents and our process. So if I'm building out a buyer candidate list for a client, I can instantaneously get a summary, for example, of every product announcement that's relevant to my client's product over the last 6 months. I can instantly get feedback on which individuals were mentioned, promised, or quoted in press releases for transactions that are relevant to us. So not only can I automate that internal process that drives our business, I can pull in outside data seamlessly and improve product and outcomes.
Great. So as a continuation of that question, like how you mentioned, like buyer candidate identification. So I just want to understand a high level view on, like, say, for example, a client comes to you for like selling of their company. Like, what's the process you're following? Like, do you already have a buyer, or like you find a buyer according to that client's requirement, or you reach out to the private equities or the corporate buyers and then identify a buyer from there? So what's the generic practice you're following?
Yeah, so we are really focused on helping our clients be relevant to buyers. Relevance is a really important word for us. There are a lot of companies cooking up cool solutions, but unless those solutions directly improve a buyer's business, they won't be considered. And so when we think about buyer candidates for a client, if it's similar to one we worked on in the past, if it's in a sector we're already familiar with, then we have a pretty large body of work. We've probably researched 1,000 companies already. We've identified 15 or 20 that are really high potential. We've identified another 30 or 40 that are maybe. We've probably already mapped out private equity investment in the sector. And so, I mean, we were just reviewing our list this morning. We have a client that, we actually have a strategic partner candidate list, and we have a financial partner candidate list, and they're very intertwined because a lot of the strategics are portfolio companies of the private equity funds. And so mapping that is critical because those guys act as bankers for their portfolios, and it's a very efficient way to get seen and get traction with those bidders. So we go back to our prior work, and we actually, the way our systems are set up, we can flag which process we had prior contact with those bidders on, and we can pretty quickly get that sort of institutional knowledge that we have. We use very few outside resources for that. It's largely, it's 11 years of our data. And then we often get pulled into very narrow niche markets. Like I sold a company that was doing in-flight software and controls for airplanes, the control software for the Airbus A380. Like, there aren't a lot of precedent transactions for that, but in those cases, we love those deals because you go very deep and narrow into a vertical market. You identify. We sold that to Ansys, by the way, but there were three, Siemens, Ansys, ATG. There were or PTC. There was a discrete group of bidders that were perfectly suited for that, and we can go in and we can figure out which division, how would this work, and get to the right people. So it's a lot of manual research labor, and more recently combined with a lot of the AI tools that we have access to.
That's great. Like, thanks for explaining that in so deep. So moving to my last question, what is that one piece of advice you love to give to someone who is just starting the career in investment banking?
In investment banking?
Yes.
I mean, Morgan Stanley just laid off 2,500 bankers, right? So that bottom rung of the career ladder is largely being removed by AI. We used to do a lot of work that felt boring as hell, like repetitive and And yet we would learn so much by just grinding through it day after day. Those are gone. So I think someone who's starting out in investment banking, they need to figure out how to be relevant in a world where a lot of the just routine work that we did to learn in the past is no longer available. And so, one approach is, instead of going into investment banking, go into wealth management, which is just a relationship business, right? I mean, there's only a few things that people are allowed to invest in anyway. So it's mostly about telling the client that they're lucky to have you because you beat the S&P by 2 basis points or whatever. On the investment banking side, though, I think you got to be AI first. You got to lean in and really be aware of how AI is transforming industries, not only to be able to leverage the tools that you're using, but also to be in the right place, in the right specialty, as certain sectors see a tremendous amount of activity from AI. Being a domain specialist has always been the ticket. Even when I was starting at Morgan Stanley, 1989, 1990, you would need someone who was really strong in manufacturing or food or what are the vertical markets. So I think it's not enough to show up with a finance degree and a good analytical skills. You need to start developing a deep awareness of a specific sector and become very adept with the tools. And then you'll probably, and you got to keep grinding, but you'll probably find a home on Wall Street.
Be up to speed, like how the market is moving, you have to also run along with that. So,
yeah, I mean, put your future hat on and say, okay, here's a segment that is largely automatable. It's mission critical, or it's a system of record for large companies. There's an opportunity to create a moat so it can't be easily disrupted. Now, if I'm thinking as an investor, I'm thinking, great, let me go find some companies that can grow in that lane. If I'm thinking as an investment banker, I need to get smart on the activity and develop relationships, because there will be consolidation and there will be deals that are happening. So if I'm aware of those companies and I'm building relationships and getting to know them and I have coverage, then I can be involved in those transactions.
That's great, Nat. So thanks a lot for taking your time. You being a CNBC speaker, I really enjoyed talking to you. It was a fortunate for us to come on a session with you like this. Thanks a lot for sharing last 30-40 years of your experience in the last 20-30 minutes. Thanks for joining with us.
Thank you. It's been my pleasure, and I look forward to seeing more from your firm as well. Thank you.
Definitely. Bye.